Good morning, everyone. Welcome to our November installment of the NAB Business Insight series, designed especially for you, our business and private bank customers. My name is Aaron Willens. I'm the executive for Melbourne here in our NAB Business Bank, and I'm really pleased to be here with our colleague John Christalis from our Investment Insights team today. Before we commence, let me recognise that I'm joining you here, and John is as well, from the lands of the Wurundjeri people of the Kulin Nation, and pay respects to elders past, present, and emerging who are attending today's call. And today we've got a terrific opportunity to talk about an important class of investments that presents alternatives to you, our clients. And it's a real point of difference that NAB has in the market. So John is a seasoned investment analyst and has a senior role within our chief investment team within NAB Private Wealth. He brings an extensive array of experience across financial markets and investments, having worked with a number of different banks and organisations across Australia. And I'm pleased to say that he's back at NAB for his second stint after having done 10 years at the bank in the early 2000s. Fixed income is a really interesting space for you all to be across. It can provide predictable income in periods of volatility. And as you would all know, we are in one of the more volatile periods of global affairs that we've seen in some time. We've seen volatility in interest rates. So understanding what your options are away from, traditional cash, traditional property, traditional equities is something that we want to ensure is front of mind for all of you as you consider what your options are into the future. We'll explore a range of different fixed income securities that are available to all of you and ways in which you can access those and ultimately deliver you a more diverse and stable portfolio mix. We've also got the opportunity to take questions. So most of you would have been used or have been familiar with how to use Zoom in the past, and the Q&A tab button, which is available on your screen. Please throw your questions into that, and we will ensure that we will get to those either through the course of the session, or if not, we will follow up with you after the conclusion of the session. Ultimately, this is designed to provide insight to you, our customers. So we're always keen to hear what's front of mind. What do you want to be hearing from us? We're sure that today you're going to get some real insight from John and take something away which hopefully is valuable to you and adds value to your family and your business. So without any further ado, John, I'm going to pass over to you.
Thanks, Aaron, and thanks for the great introduction. And you pronounced my surname very well, so thank you. Okay, all right, so let's just get into it. So in terms of timing today, possibly sort of 45 minutes sort of max. We'll have time for questions as well, either throughout or at the end. So aiming for sort of a 45-minute total time frame. I guess fixed income, it's sort of one of those terms that gets bandied around a lot. So let's just start out with, I guess the definition. So fixed income really just covers, products that provide predictable income, I guess, relatively capital stable and low volatility. So they're the general characteristics as to what you would see in fixed income products. And what you see before you is a fixed income spectrum, I guess, which is really just, I guess, from a risk and return perspective, the range of different products that are available in the market. So if you sort of start in the bottom left corner, you've got cash and term deposits. Obviously being business bank clients, private bank clients, you're all familiar obviously with cash and term deposits, and no doubt you're actively talking with your business banking manager about rates and so forth that are being offered. If you go to the sort of top right, you've got, I guess, private debt, which we'll sort of go into some detail later on. Obviously, private debt's been very topical of late with ASIC and so forth, and the number of, I guess, non-bank lenders, and I guess just private credit funds that are very active in the market now. And it becomes sort of one of the hottest sectors, globally, but certainly not without risk. And unpack some of that today. I mean, obviously, equities is at the very, very top right. So, equities is obviously not what we're talking about today, but obviously, in terms of when you're investing, you've always got in mind, okay, well, what sort of income and return and volatility characteristics am I comfortable with? So this probably just provides a nice sort of summary. So also, I mean, return on the y-axis is essentially returns from income or capital. Fixed income products are designed to generate most of its return from income and not capital. And risk down the bottom, risk is really, I guess, the risk of permanent capital loss, which obviously makes sense the further we go out on the risk spectrum. There's obviously more potential capital volatility and capital loss in that regard and obviously hopefully being compensated for with a much higher return. NAB is a fixed income specialist in terms of our debt capital market capabilities. So we pretty much participate actively across, once again, if we refer to the chart, government, state government bonds, corporate subordinated bonds, etc. NAB's actively involved either in primary markets or in secondary markets as an arranger and also distributor. Listed notes, listed investment trusts, corporate hybrids. No doubt you're all familiar with ASX listed hybrids, which we'll go into some detail later on. And obviously that market's changing because APRA has now determined that banks can no longer issue them, such as creating new product opportunities, which NAB is selectively involved in. And we'll obviously talk about that throughout the slide as well. Just please note, I mean, today we will talk about some specific sort of products and so forth, but there's no recommendation or anything like that. This is really just meant to be an information session. So yeah, that's the disclaimer. All right, so let's just move forward. I suppose let's just take a bit of a higher level view of fixed income. And no doubt many of you run SMSFs. And I guess what this sort of page here really does is just tries to illustrate, okay, what are the differences between like a typical self-managed super fund that a lot of Australian clients may have versus a professionally managed super fund asset allocation. So not that we're going to go through each asset class in detail, but SMSFs typically growth focus, so property, Australian equities, franking credits, etc., which is obviously very common strategy. Probably just highlighting because this is a fixed income webinar. In the red line, in the sort of the red portion of that pie chart on the right, fixed income is a very small sliver. Most SMSFs generally hold a lot of cash, potentially just there for a bit of a buffer, but also maybe not necessarily have any exposure to or understanding of other products that may be available. Whereas professionally managed super funds typically have a much higher allocation to fixed income. And as we sort of saw in the previous chart, obviously not without risk, but fixed income products generally provide higher levels of income relative to just cash. So this is probably just a good some good perspective for you. In terms of capital volatility, this may or may not be a busy chart depending on what you think, but so basically the blue lines, or the blue bars, I should say, that's essentially the S&P 500 total return over time since 1990. Look, as you'd expect with equities, the blue bars generally much higher and much lower at times compared to the orange bars, which is the Barclays. Basically, it's their bond return. So you notice that typically when the blue lines are very positive or very negative, typically the orange bars sort of move the opposite. And in fact, 2022 was probably the worst bond market in 50 years, as you can see on your right. But really, I guess, bonds, I guess, can help make that investment path smoother. If you sort of look at 2008, just as a quick example, if you're looking to retire and it's sort of 2008 and you had $1 million in equities, well, that $1 million would have gone down to potentially $400,000 at the worst of the GFC. Obviously, markets have recovered well over time, but if you're looking to retire within a few years, that would have been a very, very nervous environment where you're hoping that markets will recover, but getting back to your initial starting point of $1 million, that's a long way from 400,000 when you're in the depth of that sort of market correction. And so, yeah, if you do have, for example, fixed income products, like if you've got, say, a 50/50 portfolio, like, $500,000 of equities, reducing down to 250,000, still not great, but then, for example, fixed income products that have got a notional of 500,000 and balance probably still thereof, your total wealth position's probably gone from 1 million down to 750,000, which is probably a bit more palatable than going down to 400,000. So that's just, I suppose, just some context within a graph as to how to maybe think about bonds in terms of how they can reduce capital volatility. And also note, for example, if you're an insurance company, you're providing, protection, I guess, for general insurance claims or life insurance claims. If you're a life insurance company and you invested all your money in equities, well, your portfolio would have gone down by 60%. So that would have made it very challenging trying to meet liability commitments on the other side. So that's, for example, where insurers and other, I guess, conservatively run balance sheets are actively involved in fixed income. Yeah, essentially to try and manage those sort of circumstances where equities have a very, very big drawdown. So why invest in bonds in particular? So just some key points here. So fixed income market, or the bond market in particular, basically it's a wholesale market, huge market, and dominated mainly by very professional investors, sovereign wealth funds, fixed income fund managers, banks, insurers, family offices, private banks. So probably the proportion of professional money to retail money is a lot higher in wholesale in bond markets versus equities, where you've got a relatively bigger retail presence as well. It's a big market term in bond markets, 120 trillion in size, which is around 180 million Aussie worth. So it's a huge market, probably slightly bigger than the global equity market, just for context. And Australia's bond market is around 2 trillion. So, which is fairly consistent, I guess, with equity market too, where I think Australia is around 2% of global equities. So features, obviously, we spoke about at the start. So just predictable income. There's regular coupon payments, quarterly, semi-annually, monthly, for example. Much more capital stability, which we'll go through some examples shortly. And obviously, they're liquid as well. They are tradable, particularly for investment grade issuers. Diversification, we'll run through that in the previous slide. Other thing too with bonds or fixed income products, they have a maturity date. So if you think about equities are perpetual instruments. There's no actual maturity date per se. Whereas with bonds, there is an actual point in time at which there's a legal maturity date and capital needs to be repaid to bondholders. Bonds are typically issued at $100 and then they redeem at $100 at maturity. So that's generally how that market works. And bonds are held in safe custody by an external trustee. So if you think about shares, for example, so if you buy shares via a broker such as NAB doesn't hold your securities on its balance sheet. It goes to like a registrar, so it's separate from a legal perspective. And it's the same thing with bonds as well. Bonds are held in safe custody by an external trustee. Just touching on the professional nature of the market. So Austraclear parcels for bonds are sort of $500,000 minimum, which just to highlight, I guess, the extent to which it is a very professional market. Obviously, with the equity market, you can log on to your NAB trade or other provider, and you can buy $1,000 worth of shares, for example. So that's probably a key difference. And over the past decade or so, small bond parcel trading has been developed, where, for example, you can deal in sort of $100,000 minimums for direct bonds. So that's just an ongoing development in the market just to make it more accessible for high net worth investors. Okay, so comparing term deposits and bonds, no doubt. Yeah, many of you are probably you've got term deposits and maybe you've been rolling term deposits every 90 days for a long time. So it's always good to, I guess, compare products just to see how they stack up. The term deposits, generally shorter terms, sort of up to 12 months. Business bankers on the line, probably have a much better feel for the average term, but it's probably around sort of 90 days. Bonds typically are much longer. Corporate bonds typically up to 10 years. Government, semi-government can be a lot longer than that. So, state governments issuing bonds, federal government, they've obviously got much longer time frames that they're working toward, and obviously borrowing a lot more these days. But that's just a typical investment term. With term deposits, because, like let's say the example that term deposits are being renewed every 90 days, you've got a reinvestment risk because ultimately term deposits are priced against really the cash rate or the bank bill rate. So, assuming say a margin of that averages around 50 to 60 basis points over time. So when cash rates do drop, you're reinvesting every 90 days. And in the case of interest rates going down, you're reinvesting at lower rates along the way. Obviously, with like a fixed rate bonds have a known coupon, and they can essentially provide a known coupon for a longer period of time. Term deposits are limited to the ADI you're dealing with. So in the case of NAB, NAB prices its own term deposits, and bonds are essentially traded globally. It's another point of difference. You've got liquidity constraints with term deposits. You've got a 31-day notice period. Bonds, large liquid investment grade bonds trade daily, and settlements typically sort of T+2. Term deposits do have a government guarantee of up to 250. Bonds are not government guaranteed unless, of course, it is a government issued bond. That's just a quick overview of term deposits and bonds. Okay, so bond versus equity. So this is just illustrating a case study with Qantas. So we'll just take a step back. So in terms of sort of companies that issue bonds in the Australian market, so essentially, Telstra, Woolworths, Coles, all the banks, the airports, utility providers, etc. They're all sort of actively involved in the bond market. The bond market is a very efficient way of raising debt capital very quickly. Process is there's a lead arranger, for example. There'll be a bond issue. There'll be a term sheet. It'll be announced in the public, and then essentially, institutions will then bid for an allocation. Book build will close typically same day. Pricing gets finalised, and then essentially within it starts trading within sort of a few days on the secondary market. So that's typically how a bond primary issue does work. There's a lot of known knowns, I guess. You've got coupon rates determined up front, maturity date. You've got where it ranks, and we'll get into capital structure in a little bit in a bit, and so on and so on. So there's a lot of sort of structural features within bonds that provide a lot of known knowns. So essentially, back in the dark depths of COVID, obviously Qantas got hit really hard, as did all companies. So as you know, with dividends or with ordinary shares, dividends are essentially discretionary. So during COVID, Qantas, as many others did, stopped. They couldn't pay dividends, and obviously the share price was hit pretty hard. So the red line is essentially the what $100,000 portfolio of Qantas shares looked like during that time. So you had from its heights of sort of 130,000, that dropped to 40,000. So you had a massive drop. Since that time, the Qantas share price has recovered. But if you look at the black line, that was a senior bond issue from Qantas. Now, thing with senior bonds in particular, like they have to pay, and all bonds really, they have to pay coupons when they're stated, otherwise it becomes an active default. And an active default for a company is basically bankruptcy and administration. So typically they will, well, they're legally obliged to honour their debt commitments, which is why you could have sort of gone on holiday during COVID, and if you had a Qantas bond, you're still getting your coupons, and then the capital price of your price volatility of your actual Qantas bond was relatively stable. So you probably would have thought, okay, well, what's all the big fuss about? Whereas equity holders were going through a massive roller coaster. So yeah, just a case in point. So just to highlight, obviously where fixed income can provide, I guess, a much higher degree of capital stability, versus a roller coaster of equities. In terms of bonds, how they're priced, but typically bonds are issued as fixed rate or floating rate. So for those that have, obviously got commercial loans, for example, you'd be very familiar with this. So, commercial loans price off, BBSY plus a credit margin. It's no difference with sort of floating rate bonds that are pay margin over BBSW. Floating rates in some ways a little bit similar to like a rolling term deposit, if you like. Not exactly the same, but if you think about BBSW resets every 90 days, and then there's a known margin that's added to it, and that determines your coupon every 90 days. Fixed rate, as it says, so that's locked in. So, like a fixed rate commercial loan, for example, you're locked in for the term of that fixed rate, and the same with fixed rate bonds. There's a known coupon, so essentially you know exactly what cash flow you're going to get. But look, over time, and the charts at the bottom really just, I guess, just help to illustrate that over time there can be slightly more capital volatility in a fixed rate bond, because if you think about someone like Transurban, who issued 3% coupon bonds during COVID in 2021, 10-year bond at 3%. Fast forward a few years, and the market rate bonds are being issued around 6%. So, i.e., you as a holder of that bond, you're essentially going to be in a position where that bond's probably going to be trading around sort of $85, for example, as a capital valuation. Obviously that means an opportunity loss, I guess, because bonds are currently trading at 6% in the market. But what that just means is, look, over time, eventually that'll go back to 100. So I guess just highlighting one of the key differences between equities and bonds is that there is a finish line with bonds. Equities, an equity may stay at 50% lower, 80% lower. It may rebound and double, triple very quickly, or it may stay down there for years and years. But at least with bonds, you've got a lot of known knowns in that regard. So public credit markets. So you've got two main markets really within fixed income, and mind you, within equities as well. You've got obviously public markets and private markets. So public credit markets. So these are things that basically trade on in an over-the-counter market, or on the ASX, for example. Think about foreign exchange markets; they're over-the-counter markets as well. So over-the-counter markets are very large and trade globally. Obviously, within Australia, everyone sort of is focused on ASX, but ultimately, public credit markets do cover OTC and also exchanges as well. So these are just some typical examples. So in terms of issuer types, as we just sort of ran through quickly before, governments, banks, insurers, and so forth. So these are some current examples that are trading in the market. So the issuer on the left-hand side, so they're all obviously well-known names. This is, like I said, just to give you a taste of the sorts of names and the sorts of bonds that are currently trading in the market. So Ampol, I'm sure you've all filled up at Ampol. CBA, well-known. Macquarie, Melbourne Airport. NAB, obviously well-known. And Woolworths. So these are all different types of bonds. So the ranking is where essentially bonds rank. So, for example, if you think about the capital structure for NAB, you've got senior secured assets at the top, then term deposits. Then you've got senior bonds, and you've got subordinated, and then you've got hybrids, which are obviously being sort of phased out, as we spoke about. Then you've got common equity at the bottom. So the higher you are up the ranking, then obviously the less risk you're experiencing and the less return. So these call dates, so some bonds are issued with call dates, which means they can be called prior to their legal maturity. Um, I won't necessarily go into the machinations of that today, but what that does, it means it provides the issuer with some flexibility, and it provides the investor with a higher relative rate of return compared to just being in a more senior position. So you can see these legal maturities. So, wow, if I buy an Ampol bond, uh, basically this I could be invested in this for 30 years. But like I said, there are some reasons as to why Ampol would look to call that on its call date. But yeah, that's just to sort of highlight some of the key structural differences amongst different types of bonds. Coupon type, fixed floating. So fixed bonds pay coupons every 6 months generally, and floating every 3 months. You can see the coupon rate to the right. So they're known. So Ampol, that's 5.85%. That's locked in for the term. And if you go down to say sort of Melbourne Airport and NAB, they're just some floating rate bonds that are priced off respective margins over BBSW. Yeah, you can see the current capital price. So as you said at the start, the bonds are issued at 100, and they do sort of trade above or below $100, depending on a number of different factors. But that's essentially the current market price for those particular instruments at the moment. And the indicative yield is really just, think about yield. Yield is just another fancy way of saying total return, which is essentially, okay, what have I invested? What coupons or dividends am I receiving? Basically divided by the current capital price of that investment, and you just annualize it. So that's what that indicative yield sort of illustrates. And it's just to highlight some of the different types of yields that are available at the moment, mainly within that corporate senior and corporate subordinated bond space. So these are obviously direct bonds. There's just some assumptions I've got at the bottom of that table as well. Capital structure, yeah, we've obviously just touched on that. In terms of the blue sort of dashed oval that I've got there, so these are the basically ASX listed hybrids. So you've got like a typical bank structure on the left, and you've got a corporate capital structure on the right. So corporate, that's really for non-banks. They have a slightly different characteristic. Obviously, banks and insurers are governed by APRA. And obviously post GFC, there's a much higher degree of capital that banks and insurers are required to have. And so essentially that's why you see these sort of tier two and tier one references. So, but yeah, that's those tier one securities are being phased out, and they'll be replaced by mainly, I guess, just bonds as we move forward. That's how banks will fund that difference. So this is, like I said at the start, so the more senior you are, the less risk you're taking. And obviously the further down the capital structure you go, the more risk you're taking. So with fixed incomes, so there are rating agencies. No doubt you'd be familiar with many of them. S&P, Moody's in particular, and Fitch. So these are essentially, so they provide investment grade credit ratings, I should say. So if you're a borrower and you want your issue to be rated by a rating agency, then you would go to S&P or Moody's. You would basically pay them a fee, and they will then actively monitor your financial position, your business, etc., and they will then generate some sort of credit rating within the context of investment grade. Sort of triple A down to triple B minus is essentially investment grade. So obviously much lower risk of default. In the Australian market, there's only ever been 3 investment grade issuers that have ever defaulted: Pasminco, HIH, which was Rodney Adler. He was a bit naughty, a bit dodgy, and Babcock and Brown. So they're the 3 that have defaulted in Australian bond market history. As you get below sort of investment grade into non-investment grade, there's obviously just high degrees of risk. So I guess, just a bit of a euphemism, spicy versus non-spicy. So this is just to provide a bit of a context as to how, I guess, particular bond issues, may or may not be rated. Not all bonds necessarily have a rating, but these are some of the parameters by which they're assessed by major rating agencies. And it does help, I guess, bond investors compare potentially different types of issuers or different types of bonds based on the credit rating that they may have.
Hey, John, it's Aaron
Yes.
here. A question's come through with regards to the slide, not the previous one, the one prior, where you talked about Ampol and the various
Yep.
companies. So the question is, are bonds always called? For example, for Ampol, which had that 30-year maturity, but I think you
Mm.
had the 4.5 years or thereabouts. And then the follow-on is, what if, for example, Transurban have a 5-year call and a 30-year maturity at 3%? Obviously, that's a favourable rate for them. Why wouldn't they call it?
Mm. A very good question. So with the way it works with rating agencies, so for example, like Ampol may issue a subordinated bond where the credit rating agencies will assign a certain amount of equity treatment for that issue. So say the bond issue, say 300 mil, um, and structuring it this way, because essentially anything over 20 years is deemed to be more equity type. So in the case of Ampol, they get maybe sort of 50% equity treatment. So what that means on their balance sheet is 150 mil will get treated as debt and 150 million would get treated as equity, which obviously helps with their covenants and ratios. Now, you get to that call date, 4.25 years, and at that juncture, if they don't call it, then it becomes 100% debt effectively, and it becomes very expensive debt. So that's the motivation for the issuer to call it and then essentially reissue it. So that's kind of some of the I suppose you call it financial engineering that issuers and rating agencies work with to try and I suppose manage or help companies manage their balance sheets more effectively. Um, and the second with Transurban, so with most of in terms of senior bonds don't have call dates usually. They've really just there's a hard maturity date. Yes, subordinated bonds, like I said, there's really probably some capital treatment that gets assigned to the call date, and after that call date, it either evaporates immediately or it reduces. So, and that's really the motivation for these companies to essentially call it and reissue it because like if you're Transurban, you have to maintain an investment grade credit rating because they're so reliant on capital markets to raise debt capital. So that's obviously the motivator for these companies. All right, hopefully that answers that question. Please, if you've got any other questions, please feel free to post them in the chat. All right, so the ASX listed hybrid market. So this is running off. So by 2032, there'll be no more left in the market. So there's $38 billion worth of hybrids to go. So what that's going to do is obviously going to provide, opportunities, I guess, for clients or holders to reinvest. And I guess, what are different things that these clients can look to reinvest into? And this is really where, I guess, some of the listed investment trusts and the listed notes have developed. Listed investment trusts have been around for a while. I'm sure many of you are familiar with them, but listed notes in particular, which is really just trying to replicate, in some ways, these hybrid offerings where you're getting paid regular coupons. You've got sort of a known sort of investment term, and you've got certain degrees of capital buffering to try and protect to some degree the note holders. So we're just running through some of these now. So private credit markets are just a step back. So private credit markets essentially anything involving a bilateral agreement between a borrower and a lender. So direct loans to companies, CRE loans, private asset backed and RMBS securities. So the challenge with private credit is obviously the amount of due diligence involved in trying to understand risks, noting that a lot of these sort of instruments would be not investment grade if you want to think about it like that. And to manage concentration risk, you may need hundreds of these things in a portfolio. So listed investment trusts and listed notes basically have been designed, I guess, to try and provide large pools of these securities, but tradable on the ASX. So I've just got a quick table here, which is essentially a summary of listed investment trusts versus listed notes. Listed investment trusts fairly sort of more sort of equity-like. Listed notes are more debt-like, and we'll just actually run through some of these specific examples on the next slide. But that's just a good one to sort of keep in the back of your mind. Oh, sorry, another one. Okay, so there's some examples of some listed investments. Like I said, these are not recommendations or anything. These are just examples that are currently trading in the market at the moment. So various issuers, so Griffin. Now you notice at the bottom that I've just got a quick summary of to what sort of portfolio of fixed income instruments ultimately you're probably exposed to. They pay monthly typically. Yeah, if you've got return target here, which is net, BBSW plus sort of 3.5 down to sort of 2.75. Sorry, I've just gone through. Sorry. 3.5 to or sort of 3 to 5, 6% or thereabouts. They pay monthly. They're all cash distributions. Important thing, obviously, is what's the net tangible asset? What's the underlying asset value of a unit versus what it's trading at? And obviously, with fixed income type products, you'd expect to see the net asset value and the unit price fairly similar. It's not always exactly similar, but the underlying assets in a lot of these particular portfolios are externally valued, can be easily valued as well. And fairly sort of short dated, although they're, equity type vehicles and they do sort of basically go on forever in theory. The underlying assets in these LITs are fairly short dated. And essentially, whenever these individual instruments mature, they're reinvested. So there can be, sort of potentially sort of, 500, 1,000 or tens of thousands of loans within each of them. So they provide a massive degree of diversification. This is more, I guess, for investors that want more of a equity-like participation. So you are sort of getting high degrees of returns. So at the bottom, you can see 1 year and 3 year returns net, around sort of, 7 to 9% broadly, depending on the manager. And I guess the nature of their book, whether they're dealing more in, public market fixed income or sort of, private market fixed income or a combination thereof. And if you cast your mind back to the very first slide that I showed about the fixed income spectrum, certainly, private debt is a key part of the Australian market, but there's obviously a lot more risks in that part of the market, and so some of these instruments have been designed to provide a more, I guess, sort of diversified approach to investing in, we'll call them spicier types of investments, just across a much bigger pool instead of sort of having a concentrated risk or having a single asset exposure to a development loan, which obviously can have a high amount of risk involved. So listed notes, so these are probably more sort of fixed income like and essentially trying to, I guess, capture that market that is disappearing with hybrids. So these provide, sort of, I guess, a known call date, known maturity date. They trade at a margin above BBSW. BBSW is around 3.6 today. And then net as well. So you're sort of getting returns around, I guess, sort of, let's call it sort of 6.5 to 7, depending on where BBSW sets. NTA, once again, should be fairly consistent. There are times when that doesn't happen. Like, for example, there's one of those instruments there where the NTA is sort of trading well above 100, but the current capital price is 98. But typically, you would expect to see a much tighter gap between capital price and NTA. And there's a first loss absorption buffer as well. So these products have been embedded. If you think about like an ASX listed hybrid, you've got equity that basically sits below it. And in a way, this, I guess, tries to replicate that kind of, we'll call it like an airbag, if you like. So essentially, in the event that like a fund like is wound up, in the case of say Dominion, and you buy it at $100, and basically um, investors are protected, I guess, in terms of from a capital loss position down to $94, and from $93.99 and below, that would be a sort of scenario where then an investor would start to incur a loss. But like I said, this is really just to provide a degree of airbagness, if you like, around trying to provide some safety buffers. All right, it's conscious
Hey,
of time. Yeah.
John, just another question, if I can get you to hop back to that prior slide. Another question around whether the return rate is based on the capital price or the NTA.
Oh, yeah, that's a good question. Yeah, so in terms of the return profiles for most of these instruments are based on the NTA. It's probably more of an issue for the LITs, because the LITs, you're basically an equity participant in those. Um, the listed notes per se, you're essentially getting a coupon. Um, and so you're going to get that BBSW plus 3.45. So regardless of how well, or how much the underlying portfolio of instruments performs for the issuer, you're getting paid that BBSW plus 3.45. Whereas in the case of actually, they don't have an LIT, but in the case of an LIT, then you basically ride, so any upside or any downside, you ride that entirely as an equity participant, whereas as a listed note holder, you don't, basically you're getting your known coupon regardless, if that helps to answer that question. Um, I'm just conscious of time, Temper. So look, in summary, yeah, so just obviously today we've covered quite a bit. So essentially we've covered public sort of credit markets, bonds trading on exchanges, obviously, listed equivalents as well, and obviously private credit we've sort of touched on, and I guess in a way that listed notes and listed investment trusts are, I guess, trying to capture that, I guess, more illiquid market, making them sort of more, I guess, investable via listed products such as listed notes or listed investment trusts, and the ability to have very diversified, I guess, portfolios. And obviously, as an investor, if you want just a known coupon and a known maturity date, that's what listed notes provide. If you're wanting, potentially a higher return profile and you're comfortable just, not having any sort of capital buffer below you, then obviously listed investment trusts provide that for you. So just in terms of, summary, so just some key takeaway points. So obviously, NAB's a leading fixed income specialist, obviously dealing with both originate issuers and also investors as well. Fixed income products obviously provide predictable income and capital stability, which is by design. We've covered both. There are publicly traded and non-publicly traded products that are available. If you think about term deposits, they're not traded. Cash isn't traded either. Private loans. So the fixed income market is quite broad, and it's quite nuanced. But yes, certainly as an asset class, it's a very important asset class, as Aaron alluded to at the very start. And certainly, if you'd like to know more, then please contact your business banking specialist who can arrange an intro to a private banking specialist, and they can sort of arrange to have more of a sort of one-on-one or a small intimate catch up just to potentially go through this in more detail.
Wonderful. Thank you, John. Sure that was insightful for everyone on the call. I just thought we are coming close to time, but I just thought it would be useful to get your insight as to the interest rate environment. Obviously, plays a part in how investors make decisions. It has been NAB's changed its forecast view a couple of times already this year. Some of the data has surprised. What's the latest perspective that we have here at NAB, and how are you thinking about how interest rate volatility or lack thereof will be impacting the fixed income markets over the coming 12 months or so?
Yeah, great question, Aaron. Look, in terms of, I guess, NAB's sort of formal cash rate forecast, which obviously Sally Auld and her team obviously actively review. And it's obviously been a bit of a challenging time for all economists, but I suppose wind the clock back a few months ago, everyone was well, NAB was expecting to see sort of a cash rate low of around sort of 3.1% or thereabouts. The current cash rate is 3.6. Given the stronger data of late, particularly with employment's providing, is a lot, has been more robust, I guess, than what they had previously, I guess, anticipated. Obviously, inflation's been it's been sort of like, well, it was sort of drifting lower, but then it has been spikes in it as well. So I guess at the moment where it stands is it's just made the Reserve Bank really just sort of sit on its hands for now. And I guess we sort of have 3.6% as a forecasted cash rate for most of next year. I suppose the challenge for the Reserve Bank, look, there's obviously supply side and demand side to the economy. Supply side is very constrained for well advertised or sort of well publicised reasons around productivity. Obviously governments are issuing a lot more debt as well. Obviously, money supply continues to increase. So, and the problem is when you've got maybe a less productive economy, less things being produced and more money chasing, that's obviously where inflation's been a bit more pervasive. So obviously interest rates, the bond markets really drive equity markets as well. I mean, equity markets hate higher interest rates, and we've seen over the past sort of past few days just how the prospect of no additional rate cuts has really sort of made equity markets sell off quite dramatically as well. So I think, look, the path ahead, it's always a very challenging environment to, I guess, debate. It does, certainly make it from an economist perspective as well. It's really becomes, I guess, data dependent, which is a line that gets thrown out a lot. But I guess for the Reserve Bank's perspective, obviously banks are very conservative by nature. Central banks are extremely conservative. So until they see, I guess, inflation start to really, kind of trend lower again, and other bits of data that they look at, then it's probably just a case of where we'll probably stay on pause for a while, not to sort of steal Sally's sort of thunder, and no doubt she'll have some ongoing revisions and updates as we move forward. But it's been a hell of a year if you think about Liberation Day and the 6 months tariffs. So there's been a lot to digest. But as they say in markets, sometimes a lot happens, but nothing much changes. But in the current market, there is a fair bit changing as well. So.
No, fantastic. Thank you, John. And on that note, everyone, we'll call the webinar to a close. Thank you, John, again for your insights shared. As John outlined, if anything you glean today is of interest and you want to have a follow-up conversation with John or another member of our fixed income team, please get in touch with your business banker. We are working hand in glove with our private wealth colleagues across our business bank, and we want to ensure we the best of NAB. Absolutely critical to ensure that you get the best range of financial services options available to you. And this is absolutely something that we're really passionate about and keen to ensure that you've got the latest thinking, and people like John are absolutely at the pointy end of the spear when it comes to the expertise in the fields they're in. So thank you, John. Thank you, everyone, for joining us today. Again, this is a monthly webinar series everyone, designed to bring insight to all of you. So if there's anything that you want to hear from us, please let your banker know, and we'll try to get that on the agenda for calendar 2026. Have a terrific day and all the very best. Take care. Bye.
Thank you.